So welcome to interest rates. How are they determined anyway? So there is a chat button. We're also monitoring Facebook. So please feel free to ask a question, raise your hand, and we'll get that answered. So this will go for about 30 minutes, maybe a little bit sooner if we're lucky. So interest rates, how they're determined. I am Jennifer Hernandez, Legacy Mutual Mortgage. I've been lending for I'm in my 27th year, closed over 4,300 loans, and just going to give you a little behind the curtain on how rates are determined and how they're not determined. So that is the purpose of what you will learn here today. You can also always visit us at loanwithjen.com. That's our website, and it's got our contact information there. So just a quick segue, make sure that if you are searching for a home, please go to YouTube and like our library of videos. We've got over 300 videos. I've got two channels, but the one as a home buyer, I'd love you to subscribe to is Loan with Jen. So just go to YouTube and look for Loan with Jen. And I've got over 300 videos now of just different micro topics about lending. So it's a trustworthy source. That's my passion behind it, was just one place where homeowners could go to get real facts, no BS, loanwithjen.com or Loan with Jen on YouTube. All right. So this is a little nitty gritty, kind of the big fancy picture of interest rates. So I'll start actually by saying that people often will think that interest rates are determined by what the government announces that the Federal Reserve, is doing with rates. Yes, it's related, however, not directly related. So sometimes in the past, those rates have gone up, but our rates have come down. So what matters is what the bond market is doing behind the scenes and how it's reacting. So those are some of the things we're going to go over. But so I guess long and short of it, the Federal Reserve raising the rate on March 15th, I mean, it's coming. That does not mean that our rates are going to exactly go up on that day. Okay. Actually, the rates that are rising now at the making of this video is already factoring in. We already know that it's going to increase. It's no big surprise. So that's already been factored into the market. So probably they'll raise it on the 15th and the mortgages will just do what they normally do, just kind of be the same. So anyway, behind the scenes, the big picture is that banks and lenders make mortgages. They loan to, Joe Smith that's buying a house. And then then the mortgage company, so like I work for Legacy Mutual Mortgage, so then we are a direct lender, and we behind the scenes after closing, we are going to sell that loan note. The note is a commodity. It's sold on the secondary market to another investor. So that's how a lot of the mortgage banks work, is they'll sell it or transfer it, let's call it, somewhere else for the servicing to happen. That's why you'll hear homeowners say, oh yeah, I got a notice in the mail that my loan was sold. It was at Bank A and now it's with Bank B. Sometimes it might happen one or two times, and sometimes it may happen 3-4 times in the life of your loan. So, behind the scenes, there is not really any one investor that I know of, unless you go to like a small local community bank in your town, that'll just keep it forever and never go anywhere. So that's where usually if it's a true mortgage with a mortgage company, it's going to happen. It's going to be sold a little bit. And really it's no big deal other than an annoyance that, you have to change the routing information for your payment. And that's kind of all that really happens. But that being said, the bank or the lender sell or transfer the loan to a larger entity investor. The investors behind the scenes, like everything goes upward. So let's say Legacy Mutual Mortgage or XYZ mortgage companies down here, and then they sell it to some investment larger company that's up here. That company, usually then we get into things that are called like hedging. You hear the words, hedging and kind of playing in the market. So in the open bond market, there's large companies, large hedge funds, large insurance companies, big investors that we never see or talk to that are buying bulks of things, a big package, let's say. That's called a mortgage-backed security. It's a security. It's a big bulk of investments backed by mortgages. So mortgage-backed security means it's a pool of mortgages. And they're divided into what we call tranches. So that's the fancy name for there's deviations within a big pool of loans. And we're talking thousands of loans, millions of dollars worth of loans in these mortgage-backed securities. So a tranche, the definition is here from Investopedia, is a financial structure for securitized debt products, which pulls together, I'm not going to read word for word, but it's basically saying, hey, we have a mixture of people at 720 credit score, a mixture of people at 780, a mixture, maybe there's a few people in there hidden that are like at a 680. So the quality of the debt, that's why if you see the little cartoon character on the far right, you can see that AAA, AA, that means AAA is the very best credit. So there may be some B things mixed up in there. So it's a varied mixture in this tranche of credit quality and also debt to income ratio quality and product quality, like maybe some investment loans, maybe some primary residence. So as a whole, these investors want it to perform in a certain way and not have a lot of foreclosures. They want the debt to be performing, meaning they want the homeowners to be making their bills on time, right? So everything has risk. And so the better quality, there's some investors that only want the AAA stuff. There's some that'll take a B, they'll take a B and take the risk, and it might have a higher payout, higher interest rate. So that's how the fancy stuff works behind the scenes. Breaking that fancy stuff, like that stuff happens every day, all the time. And I'm on the front lines. I'm just helping the consumer, the client directly. So I'll tell you more about what happens just in real practice on the front lines. So lenders will usually have their rates available between 9:30 and 4:30 p.m. Actually, Legacy goes till 5:30, but there's a window. There's a very defined window. So depending on what lender you're talking to, you would want to ask them when they'll take, locks until. So, but the US trading markets, like actual Wall Street, is Eastern time, 9:30 to 4:30. Okay. So lenders at different companies, so the big banks that we all know their names, and even mortgage companies like us, we have a special department that looks at the rates when they come out at 9:30 Eastern. And it sees what the bond market is doing. How is it volatile? Is it not? What's happening? And then so that risk manager for whatever company, whether you're talking about a big online company, a big bank, us, that risk manager is pricing their loan sheet for the day based on what rates are doing. So then as a company, for example, Legacy, we have an established, rate, rates for different products. Okay. And we'll go over in just a little bit what determines the rate, because not everybody has access to the same interest rate. Unfortunately, there's qualifications. Okay. So that company rate sheet is performed. Now it's all very digital. In the old days, when I started 27 years ago, it was a piece of paper that I had to read a grid, and that was it. Rates. So it's important for you to know, if you are especially buying a home, that rates can change daily. Recently, we have seen rates change several times a day when things are very volatile, and there's no rhyme or reason to it. We never know what day it's going to be volatile. Depends on the bond market. So some people, a big question actually that I get from borrowers is, hey, I heard that rates change more on Fridays or Mondays or the 30th or the middle of the month. There's no pattern at all. So that's actually a myth. It just depends on, again, what's happening out in the world that's affecting the stock and bond market. So that's the brunt of it. That's the sweet of it. So behind the curtain, we're going to go a little bit more. We're going to go deeper into the slides that are coming are things that affect the interest rate and why it's very crucial that you understand as you're going out there looking for the best rate for yourself, that it's important for you to understand that every rate has qualifications to meet. So if you aren't, approved, or if that lender doesn't have your documentation and you're just shopping around online or you're just seeing something published online, it's very important for you to know, and it's really kind of very difficult to know what's behind the curtain on that particular interest rate. Okay. It's more than just calling a company and saying, hey, what's your rate today? Well, there's about 20 questions that can make sure that you're in the right product. So my personal advice to anyone looking is, make application with a couple of different lenders. If you're truly shopping around, let them see what's behind the curtain and what program you do or do not qualify for to make sure that you're getting the very best for yourself. And good news for you, any credit inquiries by a mortgage lender into your credit in a 30-day period just counts as one pull. So it's really important for you to know that your credit is not going to take a nosedive if you're shopping for a loan. Just as much as you can, try to keep those inquiries in that 30-day period. And then it's just one hard pull on your credit. Okay. So I do have actually my favorite video on my YouTube channel, Loan with Jen, is the truth about credit inquiries. And the truth is that 30 days that you have to pull credit. And the other truth is that inquiries are only 10% of your score. And so it's just not going to be much of a hit. But what is a very big benefit of getting your score pulled is that the online credit monitoring companies that a lot of people are definitely a part of, there's just so many of them. I can't even name them all on this webinar. There's probably over a dozen or 2 dozen. Their credit score is different than what lenders pull. So that's really, really important for you to know, that if you call a company and say, let's say you called me today and said, hey, Jen, saw your webinar, calling, I'm buying a $400,000 house. What's the rate today? So, and if I said, hey, well, do you happen to know what your credit score is? Oh, it's a 750. So depending on where you got that score, that may or may not be equivalent to the mortgage score that a lender is going to pull. All lenders pull from the same algorithm. There's over 25 models of credit. So all lenders pull from the same one. That's how we can sell the loans between each other. And that cartoon thing on the first slide with all little guy, the mortgage-backed security and all that, because we all pull from the exact same formula, that's how the investors have confidence in the score, because we know it's all the same. So we have seen scores differ from what clients tell us or what clients think their mortgage score is. Sometimes it's right on the money, and sometimes we've seen it vary 70, 80 points, just depending on the source of where you're pulling it from. So it's important for you to get with a mortgage lender as soon as possible. If you're like even thinking about buying a house and you're like online searching, for houses online, that means you need to be talking to a lender. If you're even thinking about buying a house, making sure that if you have any homework to do, etc. So that's what I'm going to go through in these next slides. That's really, really important. So lastly, just really quick on what affects interest rates, and then we'll go into the qualifications. Inflation, just something, a couple of tips for you to know if rates are rising or not. Higher inflation means higher mortgage rates. That's what's happening to us right now. Lower inflation, lower mortgage rates. Another thing for you to just know, just in general, bad economic news is actually good for interest rates. We like bad news. Good economic news, the economy's growing and people are making money again and unemployment is low and all that. That's higher rates generally. Now with COVID, we've seen some of those rules break and we've seen rates higher when they should be lower. And it's been really, really strange, but this is mostly historically how it happens. So for example, when investors that are buying these mortgage-backed securities feel nervous about the economy, they take money out of the stock market because it's very volatile in the stock market, and they put it in the safe haven. The bond market is safer. It's usually like government bonds and things that are just, they know what their return's going to be. They know it's a 4% bond or whatever. And their money's not susceptible to big swings like it is in the stock market. So sometimes investors will hear news in the economy and they're like, oh my gosh, we're going to sell all our stocks right now, or a big chunk of it, and we're going to go park it over here to minimize our risk. That's how it works, as simple as that. And so as the bonds get fuller, as they receive money and more people are buying bonds, the prices go up. Just like, when something is in high demand, okay, a product, let's say, is in high demand, they charge a higher price, right? Well, it's the same thing. The prices of the bonds go up. So when the price goes up, the yield or the percent goes down. So when a lot of investors are putting their money in bonds because they're scared of the stock market, that's when we normally see interest rates go down, okay? Right now, a lot of money is going to the stock market because a lot of things are on sale. And so there's a flight of money over to the stock market. So interest rates are up right now as we're talking about this. So now I'm going to get into the nitty gritty. I talked about it a little bit on the score, but I want you to understand, like, this is what I personally love this part, because I really love helping clients understand when we pull their credit that everything works in tiers. So this is something that the online can't really explain to you. They just give you this rate and it's flashy and shiny like a new toy, but we don't know what your mortgage score is, okay? Because it's different than Credit Karma. I'm just here to tell you. So let's say that, okay, so the very highest tier is 760 plus. So if your middle score, we use the middle of your three scores, we pull from all three bureaus, and we use the lower of the borrowers. So if there's a husband and a wife, or two partners, or two people, husband, daughter, I mean, it doesn't matter. Whoever's on the loan, doesn't matter how many people or whatever, we use the lower denominator of the weakest link of the credit. And everything goes in tiers by 20. Okay. So as you go up, let's start with the best zones, 660, 680, 700, all the way up to 760. So it could be that you're in between one of these tiers. Let's say that you're in the 700 tier, 700 to 719. I want to see a way if we can get you above 720 or above 740 even, because that's the next best tier. So the interest rates and the PMI on conventional loans are very, very, very susceptible to these tiers. Very. Now, FHA loans, not so much. FHA loans, really anything in that black area, same rate for the most part. Really kind of 680 above is the best for FHA. And as you go lower, FHA will go down. Most lenders go down to 600. Some go to 580. As you go lower, there's actually charges. There's more. It's higher rate or higher closing costs, one or the other. But for the most part, more susceptible on conventional loans. So if you're shopping for a conventional loan, very important to know your score, mortgage score, not just your generic online score. So that's really, really important for you to know. Okay. The other thing that affects your interest rate is the type of mortgage. So that's why it's really important for a lender to determine, are you a conventional candidate? Or are you a government loan candidate? So under each, the blue represents the types of conventional loans. So there's a conforming loan. It conforms to the Fannie Mae Freddie Mac guidelines. That's what conforming means. Non-conforming and jumbo are really mostly the same thing, but jumbo and non-conforming are similar to the guidelines are similar to those conventional Fannie Mae Freddie Mac loans. So that's why they're under that bullet point. Then you've got your government loans, which is FHA, Federal Housing Administration, VA loans for veterans, and then USDA is from the Department of Agriculture. Those are loans in more rural areas. You can do 0% down, but man, they are tough. If you're doing 0% down, it's a great loan, but it's really hard to qualify. But they are definitely out there. So it depends on the loan product that you're getting, what your interest rate's going to be. And as a sub-divot of this, what I will add is down payment assistance has a whole other level because the state, it goes even a tier further. Like, let's say the base rate is 4% on either an FHA or conventional. The state has a margin on top of that. And so those state down payment assistance programs, the rates are determined by the state. That every lender has the same rate because it's all determined by the state. So that's kind of a whole different exercise as well, that you want to talk to your lender to make sure, number one, they offer down payment assistance. We call it DPA for short. And Legacy does offer those. But again, not every lender offers those down payment assistance products. So that's another type of mortgage as well. The purpose of the loan is very important. Is it a purchase? Is it a refinance? Are you doing improvements, rolling in improvements like a little mini construction loan? Are you taking equity out of the loan? Equity loans have a higher rate than a regular refinance. They're riskier. You're going off value, and no lender wants to be caught holding the short stick that values are at the top of their game and that they have a loan out there that's today an 80% loan to value. And then 6 months from now, it's at 100% loan to value because prices of values have dropped. So that's why they're a little bit riskier, because they're giving you cash on the hopes that it's not on an inflated market appraisal. That's kind of the short of that. So depending on the purpose of your loan, that's a different interest rate. Another thing that affects the rate is amortization. So 10, 15, 20, 25, 30. The most common we see are 15 and 30. The 20, 25, and 30 year all have the same rate pretty much. Sometimes 20 will have a little bit better. And then the 10 and 15 year typically have the same rate. Clients will ask for, can I do a 5-year? On a conventional Fannie Mae loan, the amortization will not go lower than 10. It's just, again, remember that mortgage-backed security guy and that pool of AAA and B and C loans and all that. It's a commodity. And so the commodity needs to be the same. It needs to fit in the same box. If you put in that pool of loans a 7-year loan, it's just going to freak the formula out. Like, they don't know how to assess that. So everything has to conform to a very strict set of, this is a bunch of 10-year notes. This is a bunch of 20-year notes. It's just something that they can deal with, and it's more tangible. So there might be some small local banks that'll do a 7-year. They can kind of do what they want when you go to the private, private guys. But I'm talking about the stuff that's sold on the market, which is more than 3/4 of the loans out there. So this is just a quick, just a quick visual for you. And anyone that attends the webinar, we'll send this. I'll send the webinar to you so you can revisit it. And then if you do want it, just visit us at loanwithjen.com, pop us an email, and we will get you one if you're watching this later. So it just shows you that the difference between on a $250,000 loan, Just tells you difference between a 15 and a 30. The 15 year is going to have a 1745 payment versus a 30 year having a 1293. But, the interest is phenomenal. If we can ever put someone in a 15 year, the rates are better. The interest is much lower, but not everybody can afford a 15-year payment, especially right now with a lot of inflation. So while the lower rate and stuff is tempting, a lot of people, 30-year is just the most popular instrument, amortization for sure. But if you can ever do a 15-year, that's like, check it out. That's like mega, mega savings. All right. So what else factors into this is the down payment. So interest rates are definitely, so a couple of, I will tell you I put it in order of, I guess good. Believe it or not, loans with PMI, which is private mortgage insurance. Now I'm talking about conventional loans, okay, not FHA. Loans with PMI have a slightly better rate, at least with my company, they do, than 20% down loans. I know it's strange, but I do want to let you know that PMI can sometimes be your friend. So you want to make sure with your lender, you're talking about the benefits of PMI and if that's the right product for you. Mortgage insurance is the lender's security blanket. So if those loans have higher integrity or higher benefit for the lender because that insurance is there to protect the lender. So they favor those loans. And so they're like, ooh, we want to attract more of those. So we're going to have a little bit lower rate, but the difference is slight. Like instead of having 4%, you'd get 3.875. So it's a very small tick down, but hey, every little bit helps, right? 20% down. Now you start to actually get a better rate if you put 25% down and then the next tier of betterment is 40. So if you do have lots of money for down payment, consider talking to your lender about, are there benefits to me doing 25 or 40% down to just better my interest rate? And the tick down, the betterment is small, but it's there. And so if you add something here, add something there, it can add up to a quarter point at the end of the day. You never know. So talk to your lender definitely about that. So loan amount is different. Need to change my slide. I still have the old loan amounts in there. The conforming loans now, and I will correct the slide after this, the new conforming limit as of January is 647,200. And the new FHA loan limit is $420,680. So really, really cool that the amounts are increasing because average values are increasing. So I am just making a note about that I will get this corrected. So I will correct it before I send it out. But the loan amount, and then once you get into the super jumbo, jumbo is anything above that 647,200. That's the conforming. But the super jumbo is anything above $1 million. So once you start to get above $1 million, and then $1.5 million is at the next tier, and then above 3 million is another tier where the rates start to change, the requirements for down payment start to change. So talk to your lender about that if you're in that category. So we do have a question. What is the new FHA amount? So sorry for the slide. I didn't notice that I didn't have that updated. The new FHA amount is $420,680. And now, if you are on the coast, like the East Coast or the West Coast in the high cost areas, it's different. So you could just Google it and just put, hey, FHA loan limits 2022, and something will come up. But the states on the ends of the country are higher cost, higher areas, and they're higher, by the way. So that's important to note if you're watching this. Thank you for that question. All right, so fixed rate versus ARM. ARMs, adjustable rate mortgages, usually have a lower rate. I say usually, at least in what I do, my fixed rate loans, are just really the best, better than ARMs. Now, that's not the case with every lender. So if you are a potential candidate for an ARM, one lender over another may not be your best choice. So not every lender carries ARMs. I'm not quoting them right now because ours are not better, but there are some out there. So an adjustable rate mortgage does have more risk. It's only fixed for a 5, 7, or 10-year time period usually. So you're kind of betting on the odds of A, you're there that long, or B, rates are not going to go up. So we are in a rising interest rate market. So we have a lot of people that are really demanding the fixed, but ARMs are something, it is available in the marketplace. So if that is something that you're interested in, talk to your lender about that possibility. Okay. But normally fixed rate is just the way to go. It's the very much safest instrument for the most part. Okay. The property type. This is a really important one. Well, they're all important, but single family townhome have the same rates. Condominiums have different rates. Condominiums are more risky to investors. And I have a video on YouTube for why condos are priced differently. So you could go there to watch it. But condos are different. 1 to 19 stories is considered a low rise. And then 20 plus stories might have a different rate for that as well, higher rate, because they're more risky. Usually there's more units. And also now, especially with the condo in Florida last year that collapsed, there's a lot of oversight and worry about 20 plus stories, integrity of the building and make sure it's not going to collapse and all that. So if you're buying a condo, you should expect you will have a slightly higher rate. And it's not a huge increase, but it's an increase than a single family. If you're doing multifamily, like 2 to 4 units, 1 to 2 units usually have a similar rate, and 3 to 4 units have a higher rate. So as you get to 3 and 4 units, actually a bigger down payment's required as well. So again, if that involves you, talk to your lender about that. Construction loans. Construction loans are different, and they are different property type of loan. And so they will have some different rates for those as well. So if any of this applies to you, just make sure to talk to your lender about that. So property use is a huge thing. And actually we've had some changes recently about this. This is 2022. So a primary residence is going to be your very lowest rate. And then a second home is a vacation home, like at a lake or mountains or beach or whatever. So a second home is priced now as of as of January 2022, the same as investment. So before there was a betterment in pricing, and second home was very similar to primary, but that has been taken away. And so second home and investment are similar. Second home, the benefit is you can do a 10% down payment. So that's kind of one little caveat. Investment requires 20% down, at least for the Fannie Mae. Again, Fannie Mae conventional 30-year fixed loans. So again, property use does affect your rate. Okay. Another thing that's important, how to watch the rates. So a lot of people ask me, hey, do you have a website or something where I can just kind of keep track of the rates? Unfortunately, no, we actually refrain from posting rates because it's very misleading. And for all these slides prior, you can see that not all rates are the same. So it's a very, very, very delicate balance so that we don't want consumers to be misled in any way. And so we prefer that you call us to update. So that's why I just want to implore with you, watching the rates online is very, just like, mortgage companies, everywhere. You can't go anywhere online without some kind of rate popping in there. I just want you to remember, online companies pay thousands, if not hundreds of thousands of dollars to advertise because they want to get your attention. And so if you look at them and you look really close, there's something called mortgage points, which is a whole other exercise. And I got a video about that too on Loan with Jen on YouTube. Just type in the word points and it'll come up. Mortgage points is basically prepaid interest. It's you paying a fee to buy the rate down. That's the simple answer for you. So that's a lot of what you see online. If you look really closely, there's points involved. But for the most part, how you can watch rates with that, if you do, there's a lot of clients that watch the 10-year bond and they're familiar with all that lingo. And so usually the 10-year bond is the one to watch. If that yield or rate goes down, then our rates are usually going down. If you have no idea what I'm talking about and you're like, what the heck is the 10-year yield? Then you're not going to watch it that way. Just know that if the economy is doing really well, rates are likely going up. If the economy is doing really bad, or if you start to hear noise about, bad things in the economy, like bad economic things, then rates are probably getting a little better. And it's so easy to just turn on the news or the online now and get information on, good, bad, ugly, whatever it is, that you'll probably get an idea. And then that can prompt you to call your lender to get, updated on things. Okay. But this is just some quick tips for you to kind of watch the rate. All right. Call your lender. So again, the best thing to do is develop a relationship with the lender. Know that you can count on them, text them, email them. Hey, what are rates doing, et cetera, et cetera. Okay. And be close in contact with them. Searching for a house sometimes takes 5-6 months. It's not immediate. So things do change. Right now we're making this in February of 2022. And just since the new year, since January 3rd, bam, Happy New Year. Rates have been going up since then. Rates are 1% higher than they were at Christmas time. So that's a big shock. That's a big jump in a short amount of time. And so it is changing what people qualify for. So if you are pre-approved, if it's with us, that's great. Call me, make sure we kind of go over things. We're doing our best to reach out to everybody as well, but definitely you can call us as well. And we'll definitely get a call scheduled or talk to whoever your lender is to see how that affects you. Okay. When can you lock? That's really important. Rates are tied to the property address. So you cannot lock in until you have a property. Now, there are some lenders out there that advertise like, hey, lock and shop. We can lock it now. They're usually padding the rate. Like, let's say the rate was 4. If you lock and shop, they might say, hey, 4.375. So beware. It's not as easy as it sounds. And there's not very many companies are doing it because especially in a rising interest rate market, that's how companies can lose money really, really quick. So it's very rare. Most companies you can lock without any kind of upfront fee for 60 days. Anything over 60 days, generally with most companies, there's a upfront non-refundable fee to lock longer than that. So that usually comes into play with new construction. So just talk to your lender about that, but very common 60 days or less. And the less number of days that you need, the lower your rate. So if the 30-day lock is the very best execution, if you need 60 days, the rate is generally, instead of 4, it would be 4.1, probably more than likely. So just be aware of that. Okay. But it's tied to the address. So you can't lock in until you have a property address. Very important to know. So this concludes everything. We want to be your lender if we're not already. So I really pride myself with my team. What we drive home every day, and I'm always making sure we have in check, is doing the right thing, doing our best, and showing clients that we care. And also on the left, you'll see my promise also is accurate, on time, and tons of communication. So if you are looking for that, we would love to give you a second opinion or an opinion on everything. And those clients that are watching, thank you so much. And everything, all my handles and website and everything, YouTube is Loan with Jen. So you can visit us on any of those outlets. And if I haven't answered any questions when I end this, you can always just pop me a note on the side by visiting loanwithjen.com, and you'll get my contact info, and you can pop a question to us there. But thank you for watching. I really appreciate you taking your time today, and we will talk to you soon.